Wondering how ETFs can fit into your portfolio? Join us for our Fall into ETF Investing event, a 4-part YouTube series premiering on October 18th, 2024, designed specifically for DIY investors. Check out these exciting weekly events we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide the information and education you need to gain confidence and empower you to manage your portfolios. You won't want to miss these weekly specials.
Hey everyone, it's Larry Berman here. End of a crazy busy week, and as you can tell, I haven't even shaved yet today, and actually probably for a couple of days. I've been so busy on the screens post-election with the markets just zigging and zagging and ripping here or there. As everyone will know, we've got our Make Portfolios Great hat on again in symbol of the red sweep that dominated the market landscape this week. And let's take a dive into the chart room and see what we learned. So we'll get to the election in a minute, but we had a Fed meeting this week, and while it was widely expected the Fed would cut 25 basis points, and they did, what was more uncertain was the policy path going forward. And it appears in the 24 hours post FOMC, with all the digestion of what Powell said or didn't say or hinted at or didn't hint at, the market seems to think that the Fed is in a much slower mode in terms of verifying what the market was thinking. And so there's a bit of a disconnect here, because if the Fed is going to cut less, so that gives them a bit more hawkish tone. And so the long end of the curve, you would think would be worse, was actually better. This week also, we saw a 30-year bond auction, which was rated as an A+. So what does that mean? It means the demand, the subscription rate, everything about the auction was as best as it's been in many, many years. So why did that happen? Well, obviously, bond yields backed up significantly. So, on the front end of the curve, we're looking at 3 or 4 rate cuts over the next year. And so the Fed's delivered 75 already. Another 75, maybe 100 by the end of next year is probably. So it means every other meeting, it means slower. Right now for the December meeting, only a 65% chance of a rate cut. When we look at the Bank of Canada, we see a very different we see a bank that's gone well ahead of the Fed. So the target rate in Canada today is 3.75, where it's 4.75 in the States. So we're already 100 basis points lower. And we have, over the next year, also 4 rate cuts priced in. But they're 50-50 on whether December is 25 or 50. So there's much more of a need in Canada to cut rates more aggressively. And we'll talk about the Canadian dollar and the impact there in a little bit. But let's go have a look at the long end of the Treasury curve. And so we backed up. The Trump wins the election. On election night, we actually have a good sense that it's going to be a red sweep or really close to it. If you look at the prediction polls and what's remaining, 216 seats have been given to the GOP already. There's 9 undecided left. Out of those 9, almost certainly 3 or 4 are going to go to the GOP. So it's a red sweep, although not official yet as of this time and point, which is after the market close on Friday. And although bond market gapped down on the Trump victory, because there's more deficits coming, he's going to cut taxes more, it's going to be inflationary. Bond market actually, after the initial gap, rallied back. Why? Supply went down. Okay, there's no more supply for another month, and you always get that reverse kind of trade. You anticipate it and then you reverse it. We'd have to see TLTs get above 95, 96 at this point for me to be convinced that we're not going to have another major leg down, and at the long end of the curve at some point, once we know who the Treasury Secretary is, once we see the quarterly refunding at the end of January, that we don't have a date with some of these levels. Certainly 87 looks like a very big target on TLT, and then a visit above 5% yields may be in store as well. And a lot of that's going to depend on the mix of debt that's going to be financed, throughout 2025. And again, we'll get a sense of that depending on who Trump nominates as the Treasury Secretary and how they're going to go about funding that $2 trillion of expected debt, in 2025. So that's a big part of the election. When we look at what the equity markets did, and so we're looking at November month to date in this, and I've looked at and compared everything to the S&P 500 in this sense. So the S&P 500, or the biggest performer of the week was small caps. The Russell 2000, we call that small cap junk because it includes companies that aren't profitable. When you look at the Russell 6 or the S&P 600, which is the top tier of the small cap names, those really, up 9%. So, Trump's policies are going to be more positive for domestic companies than they are going to be for the ones that do their business globally, the big mega cap names, for example. So the S&P 500, had a great week, up 5.2% or month to date so far. Small caps kicking butt, mid caps doing a bit better than large caps, but not as well as small caps. When you look at the MGK, which is mega cap growth, and you compare that to mega cap value, you do see the growthier names in the big stocks did better than the value names. So what are the value names? The energy names in general, but the banks fall into that category too. And the banks really ripped, looking forward to a bit less red tape, if you will, on how they do business with Americans. So that's really the post-election wrap in terms of what happened in equity markets. The biggest question I'm going to get Monday on BNN is, Larry, what do you think now? What's coming after this? And so while we always get some post-election euphoria, I suspect with the valuation of the markets, we're not going to see, I bet we might see an extenuation of the tax cuts. That's the end of next year. Are we going to see more corporate tax cuts? I bet Congress won't support that. So I don't think that's going to happen. But continuing what we have already, probably 2 thumbs up. And so what does that mean for deficits? Again, on the debt side, we're going to see just a massive amount of deficits going forward, and it's going to limit the bond market's ability to rally. And the question is, at what yield is all that debt going to clear? So last week, the long-term debt cleared relatively well because yields had backed up. So as yields get higher, there's demand there, but as yields get lower, we've seen very poor auctions. The bond market's in a range, and the biggest stress coming in the new supply in 2025 should push the long end to the back end of that range. Now, that should impact equity multiples. And so we've got this battle going on in equities. We should get some of the froth coming out at some point, but that might not be still through the end of the year. We'll see. Is the S&P 500 worth 24 times forward earnings at this point? I got to think it isn't, but I'm in the minority there. Clearly, the commentary out of Wall Street generally very positive. In Canada, not so much. So the employment number came out in Canada for October. Missed to the downside, although the mix was for more full-time employees than part-time. I haven't dissected it completely, but I would harbor a guess that there's much more job creation there in the public sector than there is in the private sector. And on the wage side, we see inflationary pressures. The Bank of Canada is going to have a challenge too, with the weaker Canadian dollar. and the inflation, wage pressures still pushing to the upside here. The last few times the Canadian dollar was in this area, 138, 139, 140, didn't last very long. It was a week or two, couple days, a week, couple days. So this is the longest period of time the Canadian dollar has been above 138. And if you flip that around, you're 73 cents. So the longer it stays up here, the higher the probability that we break to a higher level, weaker Canadian dollar. When we expand our charts out, there isn't much in terms of support. You have to go back a number of years. The last time the Canadian dollar was at this level. And so I'm going to do a quick max out of the chart here, and this is going to take a little second here. And so the last time the Canadian broke above 140, again, very briefly in the 80s, in the mid 90s, very briefly, but ultimately when we had really bad challenges with energy prices and with deficits, the Canadian dollar, went to hell. For a couple of years. I don't think that's going to happen this time around, but definitely we could see some spikes, to the 70-cent level. It won't likely stay there for very long. A big part of that, I think, has to do with our government and their really inability to foster business conditions in Canada. And we'll have an election sometime in 2025, probably in the fall, could be earlier, and that might change. But between now and then, the Canadian dollar is still biased towards a little bit more weakness here. Anyways, that's all I have for you this week. Have a great weekend anywhere. Last weekend of golf for me here in Toronto, and I'm really not looking forward to the colder weather. Again, make portfolios great again.